Hello again, everyone. This is Gene Ahrensberg. I'm coming to you on Sunday evening, June 17th, 2012. Gold was up 2.1% this week. Silver was also up, but only by 0.6%, ahead of the Greek, French, and Egyptian elections. Moving to the subscriber pages, in this brief video, we want to share with our subscribers one of the tools that helps vulture speculators to gain long-term confidence in the midst of a terrible, bone-crushing bear market for junior miners and explorers. It's also a tool that we use to help us to know where to target an entry into stocks involved in a sure enough cascade-style panic sell-off. The tool we're talking about is a very long-term, very simple to understand chart, and we'll be sharing specific examples in this offering. A long time ago now, we noticed that some, not all, but some issues we track exhibited repetitive, extreme, gigantic volatility. However, and this is the very simple but key part, so listen closely, the volatility played out over a period of years, not weeks or just a few months, which is what a majority of the ADD-infected retail gamers are usually mentally prepared for. Maybe the best way to start is to put one of these longer-term monthly charts on the screen. Let's get started with Guyana Goldfields, symbol GUY in Canada and GUYFF in the United States. It's a 6 million ounce soon-to-be gold mine in Guyana. Now, all of these charts that we'll be seeing tonight are monthly charts, which means that every one of those trading bars that you see is 1 month. And to give you an idea of the kind of volatility that we're talking about, from December 2001 to January 2007, Guyana Goldfields traveled from 12 cents a share all the way up to $13.14. That's more than a 10,000% gain, more than a 100 bagger. Then from January of 2007 to November of 2008, during the horrible 2008 panic, Guyana fell all the way back to 61 cents a share from $13.14, a decline of $12.53 or 95% of its value. From there, it went right back up to $11.79 by November of 2010. That's an 1,800% gain, or an 18-bagger. Now we're in the midst of a new retreat in the middle of a buyer's strike. Guyana released a new feasibility study that disappointed the market, and it was a terrible time to disappoint the market, so it's once again getting crushed. It's down 85.8%, down to as low as $1.67 in this current retreat. They do have a new bankable feasibility study on the way, but the fundamentals are not what we're talking about tonight. Tonight we're talking about what we see in these long-term charts. And what we're looking at here is a stair-step advance of improving what we call overwhelming support. And it looks like it's forming with a period of somewhere between 3 and 5 years apart. Now, in all of the charts that we're going to look at today, we can't guarantee that any of them will return to their former glory. But we do wish to point out that they have exhibited extreme volatility, which has provided vulture speculators with tremendous opportunity over much longer periods of time than most of the gamers out there are looking for. And right up front, most people just don't have the patience or tenacity to game these longer periods of volatility. Let's look at a different chart, the chart for Timberline Resources. This is Timberline Resources, symbol TLR. And if you look from December of 2005 to July of 2007, Timberline traveled from 30 cents a share all the way up to $5.30, an 1,800% gain, an 18-bagger. Then during the 2008 panic, it traveled all the way back to 19 cents a share. Timberline was crushed for 97% of its value on almost no volume. At the time, we were building our position in Timberline. By October of 2009, Timberline had increased 770%. It was a 7-bagger in what was really just a few months. And now in this current buyer's strike, Timberline has lost 83.8% of its value, down to as low as 27 cents a share. Now, Timberline had to delay its scheduled start of production at the Butte Highlands gold mine in Montana, and that's for a second time. But they had to do a hydrology study, which was a disappointment, and this is a terrible market to disappoint. But we think this high-grade underground gold project is likely to get into production by this time next year. Meanwhile, it's on sale, and it's back to the zone which proved to be overwhelming support in 3-year separated events in the past. Now, we can't share these charts with everyone, but we certainly can share these charts with our subscribers. And maybe this will explain a little bit of why we can maintain our confidence in stocks like Timberline in the face of such a terrible buyer's strike. The takeaway from this chart is that Timberline tends to find support in the green. Let's review another example. Let's go to Andina Minerals. This is Andina Minerals, symbol ADM in Canada, and it sort of looks like the Timberline chart, doesn't it? From May of 2005 to October of 2007, Andina traveled from 28 cents all the way up to $5.50 a share, a gain of more than 1,800%. That's another 18-bagger. Then from October of 2007 to November of 2008, Andina lost 90.5% of its value, all the way down to 52 cents a share during the crash. Then from November of 2008 to November of 2009, Andina traveled all the way back up to $2.18 a share, about a 3-bagger. And in this current buyer's strike, it's lost 80.3% of its value, all the way down to as low as 43 cents a share. We actually missed the 2008 buying up by about 3 or 4 cents. I can't remember exactly. We were just a tiny bit too greedy then, and so we're kind of glad to get a second chance for a shot in the blue box. And what we're looking for in these particular charts is a very long-term record of repetitive high volatility, but also a certain level of support. Even in the midst of terrifying macro events in the past, Andina has shown repetitive support in the green. I guess I should say at or just above the green. In this chart and in so many of the charts that we review, they suggest that today's harsh market and horrible uncertainty is temporary. I mean, things were really bad in 2008, but they recovered, and they recovered pretty well. And I guess the point I'm trying to make for tonight's presentation is that the volatility that we are gaming here has a longer cycle than most people are geared for. And maybe that's as a result of the times we live in, the fast pace and the constant quest by many people for instant gratification. Instant gratification may work for people doing trend jumping or other strategies, but it's usually not very effective when it comes to vulture bargain hunting. Sometimes the market demands that we adjust our thinking on an issue, maybe even giving us a better launch pad to game. Let's take a look at a more pedestrian or a less spectacular issue, but we think it's gameable. Let's look at a real cheapie. Let's look at Constantine Metal Resources. Now, we gamed Constantine twice from the same support locale, and that was good enough for us to build up double trophy shares on CEM. But the current market has proven that 10 to 15 cent level is no longer overwhelming support. This market is a rough one for many of the explorers, and I suppose we should say that Constantine has lots and lots of company in this buyer strike. But if we take a trend line across those wide-spaced zone of overwhelming support in the past, it allows us to target this new blue zone as we've shown here. Now, we already have plenty of shares of Constantine, so we're not anxious to buy a bunch more, but if we didn't own any Constantine, we wouldn't mind taking a chance here in this blue box. And it may not look like all that much upside opportunity if it stays within the channel, but if CEM returns to the upper channel sometime in 2013 or so, you're looking at a potential for a 3 to 4 bagger. And that's from an issue that you can buy 100,000 shares for 6,500 loonies right now. We've got time for one more example, so let's look at a different kind of long-term repetitive opportunity. It's what we call the repeater, and we'll use mega precious metals as our repeater specimen. Now this chart has a completely different look, doesn't it? For the past 4 years, MGP has repeatedly found support at something less than 40 cents and as little as 15 cents, and it's repeatedly found resistance above about 70 cents and as high as $1.55. The obvious play is to accumulate when Mega is under 40 cents like it is right now, accumulating aggressively under, say, 30 cents, and begin letting the market have those shares back, scaling out once the price has gotten to, something with a 70-cent handle and above. But we don't get in a hurry in either event, buying or selling. Mega is similar to a channeling stock, except that instead of the trading ops coming in a matter of days, they tend to occur over a period of months, and in some cases quite a few months. Now before we move on, full disclosure, we own long positions in all of the stocks that we have mentioned tonight. Now moving to the subscriber chart for the GDXJ, just remember that we cannot know the timing of these terrible negative liquidity events the trading and market gods have delivered to us, but one thing we do know is that they represent the best of the best trading ops that we're ever going to see as vultures. Now switching to a little bit longer term chart, in real time these horrific plunges which become protracted buyer strikes are terrifying to ordinary gamers and pros alike. People succumb to their emotions, they panic. You know, what they're doing is they extrapolate the current condition out into infinity and they lose all hope. And here's an even longer look at the CDNX, the Canadian Venture Exchange Index, and when people lose all hope, that's where we come in, we vultures. We vultures game the fear, we game the panic, and we catch the babies being thrown out with the bathwater. And then we wait patiently, very, very patiently, with our accumulated positions until the wave of panic finally recedes. And then one day we wake up and find out that the buyer's strike has once again become a memory. That's sort of what happened in 2008, and that's exactly what I expect is going to happen in this event. This is the second worst buyer's strike in the history of the CDNX going on right now. And if you look at that recovery, which occurred at the end of 2008 and the beginning of 2009, all the way up to the beginning of 2011, that's kind of what we're looking for once this particular down move has run its course. Now most people would think that the return to the upside and the recovery of this market is the fun part, and we'll agree with that. But when it comes to buying, it's extremely hard to beat the kind of deals that we're seeing right now. We're seeing low volume, super spikes to the downside, even on some of the companies that we have very high confidence in. It just doesn't get any better. So I hope this look at long-term charts, long-term monthly charts, has been interesting to some of you. When the price is plunging relentlessly in yet another market from hell, we think it pays to take a look from 30,000 feet at very long-term charts, charts that give us a sense that we've been there before, and they act as a guide to show us where to expect overwhelming support to form. So what's the moral of this story today? We can sum it up by saying, don't bring a short-term trading knife to a long-term vulture bargain gunfight and expect to win. This is a long-term game of patience and of tenacity, buying and selling. Well, vultures are not and never will be day traders. We take a longer-term look to guide us and give us comfort, even in a panicky, raging storm. Long-term monthly charts are a valuable part of the Vulture arsenal, so long as they're used on these figurative long-term call options that don't expire unless the company does, the small resource companies we game. Okay, that'll do it for this time. Thanks for watching, and we'll see you all again next time. And in case I forgot to mention it, as bad as it may seem, the turtles we track here at Got Gold Report still suggest that help is on the way. Bye for now.